Today, the good news on property prices. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Shane Oliver from AMP has revised his expectations for home prices and as a result is now closer to our most likely scenario, with AMP now calling a 25% peak to trough fall in Sydney against our 20 to 30% peak to trough fall. He says that Australian home prices are likely to fall another 5 to 10% this year, driven by a further 15% or so fall in Sydney and Melbourne. Tight credit, rising supply and falling price expectations are the main negatives. Uncertainty around the impact of possible tax changes is likely also impacting investor demand, and the housing downturn will be a significant constraint on Australian growth. He expects the RBA to cut the official cash rate to 1% this year. And by the way, if you get value from our posts, please do consider supporting our work either via Patreon, here is a link, or by making a one-off donation via PayPal. Again, here is a link. We really appreciate your support to help us to continue to make great content. So, AMP says that according to CoreLogic data, up until December, capital city dwelling prices are down 7% from their September 2017 high. This masks a wide range, though, with Sydney down 11% from its July 2017 high, Melbourne down 7% from its November 2017 high, Perth down 16%, and Darwin down 25% from their mid-2014 mining investment boom highs, but other cities continuing to trend up to varying degrees. Recently, the declines have been led by Sydney and Melbourne, and house prices are on average down more than unit prices, and prices in regional centres have generally held up better than in capital cities. The fall in property prices comes after a boom most recently over the 5 years to 2017, that in particular saw Sydney prices rise 72% and Melbourne prices gain 56%. This, on top of gains since the mid-1990s, saw a sharp deterioration in affordability. Prices become overvalued relative to income, rents and their long-term trend, and reach expensive levels by global standards. The surge in home prices went hand in hand with the surge in debt that has seen the debt to household income ratio go from the low end of OECD countries to the high end. And high prices and high debt left Australian housing very vulnerable. What has changed in the last 2 years is that, firstly, it's become harder to get a loan as regulators force banks to tighten lending standards, and the Royal Commission seems to have made banks even more cautious. A big pool of interest-only borrowers are switching to principal and interest, driving higher debt servicing costs. Banks have cut lending to self-managed super funds for investment purposes in property. The supply of units has surged to record levels. Foreign demand has fallen sharply. As rising prices feed on themselves by driving expectations of more price gains, fear of missing out, or FOMO, falling prices are driving reduced price expectations and leading to reduced demand and FONGO, fear of not getting out. Investors are starting to factor in less favourable negative gearing and capital gains tax arrangements if there is a change of government. And problems regarding the La Crosse and Opal buildings have dented confidence around building standards. It's unlikely interest rate cuts will quickly end this property cycle downturn, as occurred in the 2008 and 2010-12 downswings. Rates are already low and debt is much higher, to which, I will add, out-of-cycle mortgage rate hikes are likely, as NAB demonstrated yesterday. And then he says that the Australian Labor Party's policy since the last election has been to limit negative gearing to new property and double capital gains tax on investments held for more than 12 months. This is aimed at improving housing affordability, which means lower prices. Put simply, such changes would make it less attractive for investors to invest in residential property, which would be negative for prices. A study by Riskwise Property Research and Wildgent Advisory found that this would lower property prices ranging from 2 to 3% in Tasmania to around 9% in Sydney. While the tax changes are proposed to be grandfathered, it's likely it's already reducing investor demand as investors worry when it comes time to sell their property. If the tax changes occur, then there will be less demand. Now, we think the impact will be significantly less than that, by the way, and the policy should be implemented. Now, this is where it gets interesting. He says that for Sydney and Melbourne, AMP's base case was that prices would fall from top to bottom by 20% out to 2020. However, the further plunge in auction clearance rates and acceleration in price falls late last year suggest a deeper fall, possibly of around 25%, although he says it's impossible to be precise. This suggests around another 15% fall in Sydney and more in Melbourne. A 25% top to bottom drop would take prices back to where they were in late 2014, early 2015. While prices in other cities are being affected by credit tightening, they were less speculative and so are less vulnerable. Perth and Darwin have already seen prices fall back to decade-ago levels. Other capital cities and regional centres generally didn't have a boom and so are likely to have a bust. So for the rest of Australia, flat prices to modest gains are likely. Taken together, this suggests a top-to-bottom fall in national average prices of 10 to 15%, with another 5 to 10% this year. And he makes the point that a common property myth is that prices only ever go up and never fall. But a simple look at history tells us that this is not so. Real house prices, i.e. prices after the impact of inflation in Sydney, fell 36% in 1934-35, 32% in 1937-41, 41% in 1942-43, 12% in 1947-48, 14% in 1951-53, 12% in 1961-62, and 22% in 1974-77. In nominal terms, based on CoreLogic data, Sydney dwelling prices fell 25% in 1980-83, 10% in 1989-91, 8% in 2004-6, and 7% in 2008-9. So a 25% fall this time around will be similar to that seen in the early 1980s. The housing downturn will affect the broader economy via slowing dwelling construction, negative wealth effects on consumer spending, i.e. our wealth goes down, we feel poorer, we spend less than otherwise, and if rising defaults drive a further slowing in bank lending. The first two will detract 1 to 1.5 percentage points from economic growth, and growth in infrastructure spending and business investment should help to keep the economy growing, but it's likely to be constrained at around 2.7%, which in turn will keep wages and inflation low. The main risk for banks is that the property downturn drives a rise in defaults. However, full recourse loans means that just because home prices fall, resulting in negative equity, defaults won't necessarily rise in the absence of much higher interest rates or unemployment, making it harder for people to service their loans. A big rise in defaults is unlikely. However, it is still a risk, and the housing downturn will likely mean slower bank lending, which will constrain bank profits. Constrained growth due to the housing downturn, resulting in lower for longer inflation, will likely drive the RBA to cut interest rates this year, with 2 cuts taking the cash rate to 1% by the year's end. AMP's base case is that this will occur in August and November, giving the RBA a chance to assess the election and tax cuts. But soft data could see it come earlier. Tax cuts from July are unlikely to be big enough. The government is allowing for just $3 billion per annum in tax cuts, which is just 0.1% of GDP, to head off the need for rate cuts. For baby boomers who got in years ago, have paid off their debt, and saw the value of their home rise to levels they never believed sustainable, a fall back to 2014 and 15 levels may be no big deal. But those who got in more recently and have a big mortgage, price falls are more of a downer. And it's this group for whom negative wealth effects will be the greatest. In fact, DFA is seeing a nasty rise in the number of households in negative equity now, especially from recent purchasers who have seen falling prices approaching 20%. AMP says that for millennials trying to get into the market, it's great news, assuming the housing downturn is not so great that it knocks the economy for six and they lose their jobs. But DFA believes it is time to wait on the sidelines for now, as prices will drop further despite the raft of first owner grants still on offer. AMP says that for investors, over the very long term, residential property adjusted for costs has similar returns to Australian shares, so there is a role for it in investors' portfolios. However, right now, the slump in property prices in some cities is bad news for investors, given that rental yields are often just 1 to 2% after costs. And in fact, DFA highlights that around half of property investors are on a net rental basis underwater. Falling rents in Sydney are a double whammy. Add to this uncertainty about tax, and it's not a great time for a property investor. That said, other cities and regional centres offer more attractive rental yields than Sydney and Melbourne, and falling prices in Sydney and Melbourne will throw up opportunities at some point. So then he looks at whether a 25% plunge in Sydney and Melbourne is a crash or not. Given the extent of the prior gains, it's arguably not. But a 25% national average fall would probably be interpreted as a crash. AMP's assessment is that this is unlikely unless we see much higher interest rates or unemployment, neither of which is expected, driving a sharp rise in defaults and false property sales, or a collapse in migration, which would collapse demand. Strong population growth is still driving strong underlying demand for housing. While mortgage stress is a risk, it tends to be overstated, AMP says, although we would disagree with that statement, and is unlikely to be a generalised issue unless interest rates or unemployment shoot higher. And while Sydney and Melbourne are at risk, other cities have not seen the same boom and so are unlikely to crash, which I think misses the point, because we know that mortgage stress is equally present in all of the major cities and some regional centres. It isn't just a Sydney and Melbourne thing. And there is 1 million households now in mortgage stress. Finally, AMP says that many like to make comparisons to the US at the time of the GFC, but there are two big differences. Australia has not seen the surge in subprime loans, where money was lent to home owners who often had no income, no job, no assets, called ninja loans. Secondly, our mortgages are full recourse, meaning we won't see, quote, jingle mail, where homeowners can send back the keys just because the house value falls below their debt, which then saw the bank put the property back on the market, pushing home prices even lower. To which I say, first, some US states do have full recourse. And second, our version of ninja loans are in fact the interest-only loans, which made up a significant segment of the market. We know that there is around $120 billion for reset each of the next 3 years, of which a third will not be rolled at all. And in addition, the Royal Commission demonstrated that significant numbers of households had loans they should never have got, and as income remains compressed, that's a problem. And to add to that, there is more evidence of pressures from high bank funding. The BBSW is higher again, confirming that banks have a margin problem and need to hike rates. Damien Boy at Credit Suisse published a note on this. He says the wider spreads which are showing up in the interbank market will likely lead to out-of-cycle hikes, not because of elevated funding costs per se, but rather because of prevailing counterparty credit risks tied to a slowing economy. After all, the interbank system is merely a transfer or payment system, meaning that one bank's gain is another bank's loss. The zero-sum game aspect of the interbank funding system means that funding costs per se should not have a system-wide impact on mortgage pricing. The RBA, of course, thought that it had dealt with these pressures a while back through more extensive open market operations, but yet, here we are, almost a year later, still dealing with elevated spreads. These are wired in now. While the Hayne Royal Commission may have slowed the responsiveness of mortgage pricing to interbank spreads, Boyes says it appears that ultimately historical relationships have reasserted themselves. All banks are feeling the pressure to hike rates out of cycle, especially because interbank stresses have been so persistent despite all attempts from the RBA to soothe the market. there are still another 50 basis points worth of out-of-cycle hikes to come. Another 0.5% of mortgage repricing is due. And banks still seem to be a little behind the curve on their pricing behaviour. For as long as interbank spreads remain elevated, the mortgage rate will continue to rise relative to the cash rate. After all, mortgage rates theoretically reflect the average cost of funding, while interbank rates represent the marginal funding cost. High marginal costs eventually leads to higher average cost and higher rates, even though, technically speaking, our argument is not based on funding costs per se, but rather what spreads are telling us about counterparty risk. Mathematically, out-of-cycle rate hikes lower the neutral rate of interest, supporting bonds. This is because the RBA needs to work harder to deliver effective relief to overgeared households for a given rate of nominal GDP growth. Indeed, Boye estimates that the neutral rate has fallen to 1.7% on the assumption of complete pass-through. If indeed there are 50 basis points worth of out-of-cycle hikes to come, and assuming the banks avoid the evils of negative rates, the maximum degree of pass-through drops to 66%. Under this assumption, the neutral rate falls to 1.1%. So this is further evidence of the troubles ahead. As Morgan Stanley put it and reported in the Financial Times, the property slump could torpedo Australia's run of 27 years without a recession, a modern global record. We think the steep downturn in house prices exposes Australia to the risk of recession, particularly in the context of an exogenous shock, such as slowdown in Chinese growth, said Daniel Blake, the lead author of the Morgan Stanley report. Our models show that Australian households are most exposed of any G10 country to a housing slump and face a period of deleveraging, leaving growth heavily reliant on public spending on health, education and infrastructure. So in summary, we see the economy playing out in line with our scenarios, and that is before the impact of external shocks are considered. Add in China slowing, pressure in the Eurozone, and the Trump bump potentially turning to a Trump slump, and falls in prices of 40% plus are indeed on the cards. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.